What's up YouTube, Dougie Chong here. Welcome to today's episode where I'm going to go over some differences between mortgages. To start things off, I'll start with a disclaimer that I am not a mortgage specialist, but this is just my experience with mortgages and some factors that you might want to consider if you're getting a mortgage. I know that mortgages are a dry topic, but I'll try to keep this video as exciting as possible because mortgages are very important at the end of the day. So what exactly is a mortgage? Well, to put it simply, it's an overly complicated financial instrument used to borrow money in order to buy a real estate property. The term mortgage actually has Latin roots to die, meaning that this debt load will be carried with you to your grave. The exact formula for how interest on a mortgage is calculated is actually somewhat complicated. I'll list the formula somewhere here. The formula doesn't involve anything more than high school math, but I think the majority of the population will not understand it or even care to understand it anyways. For those of you interested in the math, it's not simply adding the percentage onto the amount you borrow and then dividing by the number of payments. What people do understand is a certain amount that they have to pay monthly or weekly, and that is the amount that is typically quoted. Thankfully, there are a lot of online calculators these days to tell if the payments are correct for a quoted interest rate. There's a lot to cover when it comes down to mortgages, and that's why mortgage brokers exist, but in this video, I'll be covering three main topics. The first topic I will discuss is the difference between a fixed and variable rate mortgage. The next topic is a difference between high ratio and low ratio mortgages. And the third topic is about the differences between different mortgage brokers here in Canada. A slight disclaimer, this video will focus on Canadian mortgages, but some things such as how interest is calculated will be universal. So the question of whether to use a fixed or variable rate mortgage is probably one of the most important questions you will have to answer when getting a mortgage. The answer to this question will partly depend on the economic situation of the country that you are in, as well as your personal level of tolerance for risk. In its simplest form, a fixed rate mortgage will have the same interest rate over the entire term, whereas a variable rate mortgage will change based on the prime rate of the bank. A term is essentially a chunk of the mortgage, not to be confused with the amortization of the mortgage, which is the entire length. Basically, in the States, they have mortgages that can run for 30-year terms, which is very good for knowing exactly how much your payments are going to be across the entire length of the mortgage. But here in Canada, the longest terms you can get are really about 10 years. After that, you either have to renew your mortgage for another term or pay off the remaining balance. The other confusing term when it comes to mortgages is the idea of the prime rate. And to make things even more confusing, each bank will have a different prime rate. And this prime rate is linked to, but not the same as the Bank of Canada's overnight lending rate. The Bank of Canada's overnight lending rate is how much one bank can charge another bank in interest to borrow overnight. So basically, when you borrow from a bank, they'll borrow from another bank, and the difference is what the bank will make. Right now, the overnight lending rate here in Canada is a measly 0.25%. So whereas you might think a 2% mortgage rate is amazing, think that banks can borrow money for 0.25%. So why isn't the interest rate that banks charge closer to this overnight lending rate? Well, banks want to make money for one, and it doesn't take into account all the mortgages that default. So the prime rate of a bank is basically the best interest rate that they'll give to their most credit-worthy clients. To calculate credit score is an entirely different topic. I'll leave a link in the description below. You can find the prime rate of a bank on most websites. On TDs right now, I think it's about 2.6%. It's interesting to note that if you look under mortgages, the prime rate is 2.6%, but if you look under home equity flex line, it's about 2.45%. So now that we have a prime rate, you would think that fixed mortgages would just be that prime rate across the entire term, and variable rate would change as the prime rate changes, but you'd be wrong. You see, banks and lenders will typically offer a set amount under the prime rate. So for example, right now, TD has a prime rate listed at 2.6%, but they'll charge a variable rate of 2.15%, which is prime minus 0.45%. As a bonus tip, the posted rate is never as low as they can go. If you just ask them to lower it, or if you ask them if they can get a better interest rate, most of the time they will be able to do so. They just post these high rates, so when they offer you the lower rate, you feel like you got a good deal. I really don't like this part of the industry. Can you imagine if a company like Rogers listed internet plans for $80 a month and all you had to do was kind of call and then you could get the plan for $70 a month? Okay, maybe Rogers is a bad example because that would probably work, but I believe that companies should post their lowest prices to remain competitive. I don't think they should post high prices just to make customers feel better when they get a lower price. Granted that some of this discount does come out of the commission of the mortgage broker, but I think it's still a very misleading practice, and I think some laws are being put into place as to how high they can post their interest rate. This is so that banks can't post ridiculous interest rates like 10% and then offer you, the consumer, a 2% interest rate, making you think you got an amazing deal. Alright, so now I think you should know the difference between a fixed rate and a variable rate mortgage. Fixed rate, the interest stays the same throughout the term, whereas variable rate, it changes. It's important to note that the payment amounts stay the same. In a variable rate, as the interest rate changes, it's just the amount that goes to principal and the amount that goes to interest will change. Let's take for example, if your monthly mortgage amount was $1,000 and $800 went to interest, whereas $200 went to the principal. Then if your interest rate went down, maybe $700 would go to interest, whereas $300 would go to the principal. And on the flip side, if the interest rate went up, then potentially $900 could be going to interest and only $100 to principal. And if the interest rate goes too high, you'll hit something called the trigger rate, which essentially means that the amount of interest you owe is more than your actual payments, and hence your payments will have to be increased. Kudos to anyone who made it this far in the video. I know it's a lot to absorb, but feel free to ask me in the comments below if you have any questions about mortgages. So how do you decide between fixed rate or variable rate? It all depends if you think the prime rate will go up or it will go down. To promote economic stimulus, the Bank of Canada will typically try to lower rates. And if the government wants to slow down economic activity, it will increase the rates. So in times of recession or economic instability, such as we are in right now, they will want to lower rates, and that's why I believe right now, as of July 27, 2020, it's a good idea to get a variable rate in my opinion. Some people might argue that fixed rates are the lowest they've been in a long time, but I really don't see the rates going up anytime soon. Furthermore, if during your term you want to switch from a variable rate to a fixed rate, you are allowed to. I'll talk later on in this video about the differences between lenders. Some lenders might not let you do this, and some might charge a fee for you to do this. The one caveat with switching from variable rate to fixed rate is that you have to stick with your original lender. So you can't shop around and get the best rate possible. So your broker might stick you with a really bad fixed rate. I know it's a really crooked industry, but at the end of the day, these mortgage brokers just want to make money. The one time you might want to for sure pick a fixed rate interest over a variable rate mortgage is if you can barely afford your payments. This is because if the interest rate does increase past the trigger rate and then you're unable to make your payments, you will default on your mortgage. However, as some general investing advice, I do not recommend overextending yourself and buying something that you can barely afford. I know this is something that's easier said than done, especially in a hot real estate market like Toronto. But really, I would recommend that you look for something smaller if you are on the verge of affording your payments. Let me know in the comments below whether you think variable rates are better right now or fixed rates. Alright, so fixed or variable rate mortgages are only one aspect when it comes to mortgages. Another important factor is whether your mortgage is a high ratio mortgage or not. A high ratio mortgage is one where you put less than 20% down. In Canada, I believe you can buy a property with as little as 5% down payment. This applies for properties under 500K, then properties from 500K to 1 million, there's a slightly more complex formula, and anything over 1 million does require a 20% down payment. So why is there such a huge distinction between high and low ratio mortgages? Well, any high ratio mortgage is considered a high risk mortgage. And since it is high risk, you are required to buy mortgage insurance. This is very different from home insurance. I'll leave a link in the description below to a website where you can calculate how much your mortgage insurance would cost. But basically, if you put 5% down, then the mortgage insurance would be 4% of the amount you borrowed, and it would kind of just be incorporated into the amount that you borrow. You also have to pay the PST on that amount upfront right at closing, and that's about 8%. It's because of this added cost of default insurance that a lot of people think 20% is the best amount to put down for a property. However, putting only 5% down significantly lowers your upfront costs, and you can use this money for other investments. So be sure to consider all your options and don't rule out high ratio mortgages, especially when interest rates are so low right now. There are also two other main differences when it comes to high ratio mortgages. The first difference is that they will be able to offer you the lowest rates possible. This is because your mortgage is insured. So if you default on it, the Bank of Canada or whoever insured your mortgage will pay the lender back. This is typically the interest rate that is quoted on most websites. If you look under the little star, it'll say that this interest rate only applies to high ratio mortgages. The second difference with high ratio mortgages is that the highest amortization length you can get is 25 years. This is the typical amortization period of most Canadians. So to summarize, high ratio mortgages are mortgages with between 5 to 19.9% down payments. They offer the lowest interest rates, you have to get mortgage default insurance with them, and then they have amortization periods of 25 years or less. On to the final topic of this video, I will discuss some differences between different brokers. Full disclosure, I only have one mortgage with one broker right now, but I did interact with some other brokers while I was shopping around. I'll go into more detail on the purchase of my property a little later, but basically an important rule when it comes to mortgages is to always shop around. The first broker you go to will kind of discourage you from shopping around and they'll say it affects your credit score, but it's really worth it to shop around and compare rates. Your credit score might take a tiny hit, but if you have decent credit, it really won't affect you all that much. If you have nothing to compare against, your mortgage broker really can charge whatever they want and you might be stuck with the posted rate. But in general, the big banks in Canada, such as TD, BMO, and RBC, really won't be all that different. But independent lenders will have a lot of different terms and conditions when it comes to their mortgages. Typical differences are penalties to switch lenders, penalties to break your mortgage, penalties to make prepayments, and penalties to make lump sum payments. Independent lenders will typically offer the lowest rates, but I opted to go with TD. I think HSBC has some of the best rates if you want to go with a big bank, but I heard their customer service isn't the best. I recently got a mortgage now at 2% that was quoted as prime minus 0.45%. If you recently got a mortgage, let me know what rate you got in the comments below. It's hard to imagine that just about 6 months ago, 3% interest was considered a pretty good rate. I know this video was a lot to take in, but to summarize, fixed rate mortgages have the same interest throughout their term, whereas variable rates change. A high ratio mortgage will have a down payment of less than 20%, whereas a low ratio mortgage has a down payment of more than 20%. And independent lenders will typically offer the best rates but have stricter terms. That's it for this video, guys. I hope you learned a lot about mortgages, and I hope that this video helps you decide what type of mortgage you should get. I will make another video with even more topics about mortgages. There's really a lot of factors to consider. Please leave a like if this video helped you at all, and don't forget to subscribe to the channel if you have not already. Enjoy the rest of your day and see you in the next video.